Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring to you the most important stories that move the markets. I'm your host Anurag Bansal, and in today's episode we'll talk about 5 big stories. First, we'll talk about SEBI's new asset class proposal for those people who can take more risk. Second, we'll discuss a major crypto hack that took place yesterday. Third, we'll discuss what the IMF is saying about the Indian economy. Fourth, we'll discuss what the head of Jefferies is saying about India's bull market. And finally, fifth, we'll talk about the Q1 results of Asian Paints and Bajaj Auto. See, if you're a regular retail investor, you can put your money in stocks, ETFs and mutual funds. But what if you're rich? Well, then you have got some more fancier options like portfolio management services or PMS or alternate investment funds or AIFs. The catch here, of course, is that you need a minimum investment amount. The amount is at least 50 lakhs for PMS and 1 crore rupees for AIFs. Now, SEBI recently spotted a problem here. There is a huge gap between mutual funds where you can start with as little as 100 rupees and PMS where you need 50 lakh rupees as minimum investment. They are worried that this gap might be leading to a rise in unauthorized portfolio management and advisory services. So what's the solution, you may ask? See, the SEBI has come up with a new proposal for a new asset class that sits right between mutual funds and PMS. Now let me break it down for you very quickly. The new asset class would require a minimum investment of 10 lakh rupees and could be offered by existing mutual fund companies. This new asset class can use futures and options for more than just hedging. Unlike mutual funds and PMS, it can make directional bets in the markets as well. SEBI is talking about strategies like long or short funds which have both long exposure to stocks and short exposure in the same fund. For your context, mutual funds and PMS are long only. They have also stated that this new asset class can run strategies like inverse ETF. In simple words, inverse strategies move opposite to an index. Say for example, a Nifty inverse ETF will fall if the Nifty index rises and vice versa. Basically, this is a trading instrument to short Nifty without directly using futures or options. SEBI is also proposing to allow higher concentrations for single stock positions, higher limits for risky bonds, and more flexible sectoral exposure limits. In simple words, this new asset class can take higher risk than traditional mutual funds. Now, this new proposal is also interesting because SEBI has been trying to slow down F&O participation in the market. This new asset class, however, could be a way for people with higher risk appetite to get into regulated leverage products. It is also interesting that they are now allowing leverage at the 10 lakh rupee level when it is not even allowed in PMSs at the 50 lakh rupee level. Currently, the only way to get regulated leveraged products is through AIFs, which require a minimum investment of 1 crore rupees. But all said and done, it is important to remember that this is just a proposal for now. SEBI is asking for public comments, so we don't really know what will come out of it. Moving on, let's talk about a very important story. Yesterday, one of the biggest cryptocurrency exchanges of India, WazirX, experienced a massive security breach. Hackers managed to steal over $230 million worth of crypto assets from the exchange. This breach hit one of WazirX's crypto wallets on the Ethereum blockchain. Now, according to a cybersecurity firm, PeckShield, the exact amount of the hack was $234.9 million. We don't know the actual numbers, but if this number is accurate, the WazirX hack will become the 8th largest crypto hack in global history. For your context, the biggest hack was Ronin Network, which was worth $625 million, and it was as recent as 2022. Now, as damage control, WazirX has acknowledged this issue and has temporarily suspended all withdrawals to protect its users' assets. But it's interesting because the growth in crypto has really outpaced their investments in security. In 2022, about $3.8 billion was stolen from crypto exchanges via hacks. The number fell to $1.7 billion in 2023, but it is still a large amount of money. In India, the government has indirectly discouraged crypto investments by making it really expensive for people to trade in it. For your context, there is a flat 30% tax on gains from cryptos and NFTs in India. There is also a 1% TDS on crypto transactions above 50,000 rupees. Now, funnily enough, the scammer seems to be dumping some of the more smaller tokens like Shiba Inu, etc., and these meme tokens have fallen by as much as 10 to 20%. Now, moving on to the next story, the IMF, or the International Monetary Fund, recently released its report on the World Economic Outlook update for July 2024. The IMF publishes this report twice a year, and it basically gives us a bird's eye view of how the global economy is performing at large. This is interesting because it gives us a good overview of the key economic trends and the forces that are moving the global economy. Let me explain it to you in really simple words. First of all, let's look at what the IMF is saying about the global economy. First, they're projecting global growth of about 3.2% in 2024 and 3.3% in 2025. If you ignore the crazy drop in 2020 due to COVID and the rebound in 2021, we are practically back to pre-pandemic growth levels of around 3%. Second, most countries are seeing positive growth except the US and Japan, where things have really slowed down. Very surprisingly, Europe, which has been very stagnant for almost a decade now, is slowly showing signs of life too. Now in that context, let's talk a little bit about inflation because that has been a hot topic for the last 5 odd years. The IMF says that inflation is still falling, but it is slower than before. Why, you might be wondering? That is because while goods inflation has dropped, services inflation is still very sticky. If you're wondering why service inflation has been sticky, let me explain. Look, during the pandemic, everyone was buying things online because they just could not go out. So goods inflation spiked, but services got cheaper. And now that people are out of their homes, they want services again. Hence, there is more demand for workers, which is pushing up wages and keeping services inflation high. In many countries, energy and food price inflation is almost back to pre-pandemic levels. In last week's episode, we also discussed this being a problem in India. Now, because of all of this, inflation might stay higher for much longer. This means central banks might not cut interest rates as much as we'd like it to be. And this, of course, is not great news for the markets. Now, coming back to India, the IMF is projecting a 7% growth for the country. This is up from about 6.8%. And this is because they think private consumption, which has been pretty weak by the way, is set to improve, especially in the rural parts of India. With growth in advanced countries being so slow, India and China are now expected to account for almost half of global growth. In one of our previous episodes, which was titled "Are we in a bull market or a bubble?", we had also spoken about how pretty much all stocks, both good and bad, are going up because of this raging bull market. Look, the Indian markets are at an all-time high and all kinds of stocks have been going up. It is a market where no matter how hard you try, it seems almost impossible to lose money. The sentiment around the market is also extremely bullish. Foreign investors have never been so attracted to India, and the same goes with domestic investors as well. This can be seen from the fact that domestic fund flows and FPI flows have been very strong. If you look at the markets from the bottom of the COVID lows, the Nifty 50 large cap index is up about 180%. The Nifty Mid Cap 150 index is up by about 370% and the Nifty Small Cap 250 index is up by about 470%. Now with a few minor bumps, the markets have gone up in almost a straight line. With all of this has given rise to concerns about market valuations and whether we are in a bubble. Now why am I saying this, you might be wondering? See, recently Chris Wood, who is the head of Jefferies, spoke to CNBC about the outlook for Indian markets. Chris Wood is best known for his Greed and Fear note where he writes about the markets and the global economy. He talks about some very interesting insights. Let me start with the good news. Chris is still bullish on India and he thinks that this bull market won't really end anytime soon. He mentioned a few factors for the continued bull run. First, the rise of equity culture in India. He drew a comparison to the 401k retirement system in the United States. See, 401k is a mandatory system for corporate employees in the US. It is very similar to the NPS and EPF that we have in India. Chris says that over a period of time, Indians will start saving through vehicles like NPS, etc., and this will lead to a new and sustained source of inflows into equities. This means domestic investors will be more important than foreign investors. Let me quote something he said.
The positive story is to see this as the beginning of an emerging sort of an equity culture. And if you go back to take the US example, between 1980 and 2000, we had a huge growth in equity investing in the US with the arrival of the 401k portable pension plan.
The second interesting thing he said is that India is under-owned by global investors. The only real investors are some emerging market ETFs and mutual funds. Global funds have very little exposure to India, and one of the big reasons for this is that getting an FII registration is very hard. He further said that there are only a few ADRs like Infosys and HDFC listed in the US, and these are the only exposure global investors have to India. But banking and IT have been some of the poorest performing themes in India in the last 4 to 5 years if you look at the trend. So global investors have really missed out on themes like PSU banks, energy, infra, defense, etc. that have gone up spectacularly. The one negative he stated, however, is that the government can potentially change the long-term capital gains tax. Over the last year or so, there has been increasing chatter or talk about the government reducing or tinkering with the LTCG or long-term capital gains tax. This has led to some interesting back and forth on Twitter between market experts. Samir Arora of Helio Mutual Fund has made a very interesting observation around this. He said, no LTCG tax is the best thing to create wealth for the Indian public, attract foreign investments, divest PSUs, etc. Hopefully, discussions about LTCG going up or changing remain discussions only in our interest. Now moving on, let's talk about Asian Paints and their latest quarterly results. They recently released their numbers for Q1 of FY 2025 and there is some really interesting things to look at here. First off, Asian Paints performed pretty weakly this quarter. This is quite shocking because people always expect Asian Paints to grow in double digits no matter what happens. But why has the performance been weak? Well, there are two main reasons. First, due to general elections this year, there was a lot of labor movement across the country. This means that there weren't enough painters available to meet the demand. Second, heat waves hit the country really hard. So not many painting jobs happened, especially for the exteriors. Now, even though the overall quarter's performance was subpar for Asian Paints, if you break it down monthly, there is a different story to be told. See, April and May were particularly rough months because of the elections and those heat waves which we already discussed about. But if you look at June, this month saw a good recovery. According to Amit Singhal, who's the MD and CEO of Asian Paints, both volume and value growth picked up as the election fever and heat waves both subsided. Looking at this trend, Asian Paints is expecting a very strong second quarter. Why, you may ask? Two reasons again. The upcoming festive season is expected to boost demand since people tend to buy and also furnish their homes around this time. And second, monsoons have really eased the heat waves out and have also improved the overall market sentiment. By the way, we've spoken about this previously as well, as you would remember. Now, you know how we've been speaking about India's rising inflation very often on this show? Asian Paints has also been feeling the heat. Therefore, they recently announced a 1% price hike across all their products. CEO Amit Singhal also went to the extent of saying that they are open to hiking prices further if inflation continues to rise in the country. In one of our previous episodes, which was titled Real Estate is Back from the Dead, we had spoken about how the affluent crowd of India is tending towards premium homes. Now here is a quick refresher in case you missed the episode. The premiumization trend in India's top 8 cities is so strong that houses priced above 1 crore rupees have contributed over 40% of total sales in these markets. Also, sales in the 1 crore plus segment have grown by a massive 51% year on year. This trend is benefiting Asian Paints as well. Its premium and luxury segment was a bright spot here. So all in all, to sum things up, Asian Paints had a weak quarter 1, but they're also expecting a recovery in quarter 2 due to the festive season and better weather conditions. Plus, the growth in premium real estate could be a long-term boost for the business. Moving on, let's discuss Bajaj Auto's latest quarter results. Since we had discussed Bajaj Auto launching the world's first CNG motorbike in our July 8th episode, it is probably a good time to discuss the company's quarter 1 results as well. Let me break it down for you into very quick pointers. First, Bajaj had a great quarter. It beat market expectations on both revenue and growth margin expansion. Second, EV sales are picking up pace for Bajaj. They grew by almost 30% from the previous quarter. In fact, in the January to March quarter, Bajaj sold nearly 40,000 Chetak scooters, which almost matched their entire electric scooter sales for the previous FY. For your comparison, Bajaj had just sold 993 EV scooters in 2022. Third, three-wheelers are also doing great for Bajaj. About 19% of their three-wheeler portfolio has now become electric. They seem so confident about this segment that they are now investing 400 crore rupees by early FY 2025 in a new dedicated EV three-wheeler manufacturing facility. Fourth, Bajaj is also going big on premium bikes, especially their Pulsar lineup. They just launched a new 400cc Pulsar. And while they're hopeful about its impact, we'll really have to wait till the next quarter to know what happens. And of course, sixth, there is the CNG powered motorbike that we had talked about earlier as well. This is targeting the semi-premium category of India and promises a massive mileage of 102 km per kg of CNG. Now, with CNG prices at around 75 rupees per kg in India, this could cut costs for regular motorcyclists by as much as 65%. Now, here is why Bajaj's premiumization plan is very interesting. See, the number of affluent Indians in India, which is those people who earn 10 lakh rupees or more per year, is growing at 13% annually. This population could touch about 100 million by as early as 2027. And the thing about this segment of population is that inflation is less of a factor and would not really affect this population's spending dramatically. Well, that's all the news I have for you today. I hope you found value in this. I'll see you tomorrow. Take care. Bye bye.